Are we back in the bull market? That's the big question, because it definitely feels like this. Bitcoin went up more than 12% in the last 24 hours. Ethereum went up even more. I want to share in this video a quantifiable approach. So let's take a step back. Let's try not to be influenced by the emotions of the massive downs and subsequent ups. Let's try to find out historically, if we use the same kind of trading rules, what would have worked in the past. I've shared this several times on this channel, but I want to dive into a few more details this time. We're going to look at a trend following strategy. We're going to look at a strategy that buys in whenever prices tend to rise and that sells or even shorts the price when prices tend to fall. You might already know where I'm going with this. I'm going to talk about the 120-day simple moving average, but we're going to talk about some details of that backtest in this video. The moving average historically was the best of all simple moving averages for Bitcoin to time the bull markets and the bear markets. So we would be out of the market or even short prices whenever the price is below the moving. So we would be shorting the Bitcoin price during times like this, and we would be longing, we would be buying Bitcoin during times like this. Currently, the price is below that moving average. We have simply crashed that much that even this massive recovery in the last 24 hours could not yet bring us above the moving average. But why is this line so important? How well does this strategy actually work? I want to share this in this video. I'm using that approach already for several years. I'm also including trading fees in this backtest. Let's dive into this. Because in case you are wondering, this is the result of the backtest, right? At the bottom is the Bitcoin price and the backtest result is over here. This is why I like the 120-day simple moving average so much. But one step at a time. The data that we're using starts in August of 2017, so 7 years ago, and it goes all the way to 1 month ago. So this is when I last time ran the numbers. And what we're doing here is we are back testing different moving average durations. So daily moving averages, we use daily tickers. We go from 2 days all the way up to 200 days. So we're trying to optimize what moving average worked the best. Now, this is not just an exercise to optimize, it's also trying to find out if in general this strategy tends to work. Is it really important to take the 120-day simple moving average? Or would a 100-day also work? Or would an 80-day also work? Again, we're trying to find a quantifiable approach that's completely released from all emotions to time the market well, that historically worked well, that we think will also continue to work in the future. I have used the results of that backtest already for more than 2 years. So let's have a look at the results. At the bottom, we've got the duration of the moving average. And on the x-axis, we have got the annualized performance. So the performance geometrically that we got per annum. If you bought and held Bitcoin over the time period, you would have seen the price moving from $4,300 all the way to $54,000. That equates to an annualized return of 28%. So that's the black line. On the x-axis, again, we've got the moving average duration. Thus, if we have an average above 30 days in duration, we tend to outperform buying and holding. If you go too short on the duration, then the trading fees might kill you. If you go too long in the duration, then you are not reactive enough to the current price movements, and then you simply just get what buying and holding provides. So there is an optimum, and the optimum is over here. It's the 120-day simple moving average. Now in this backtest, I've made several assumptions. The first assumption is that we start with $1,000 and that with each trade, we're losing 0.2% in trading fees. Now, if we go long and then we turn the position into short, we lose this twice, because first we close the long position, then we open the short position. So we would be paying 0.4% for each change in position. What we also assume is whenever the price is above the moving average, that we go long. So we bet on rising prices, but we're also betting on falling prices whenever the price is below the moving average. So again, we bet on rising prices over here, but we also go short in situations like this. We bet on falling prices here to then go long again, to then go short again. Now we can actually isolate this. Let's have a look at only the short signals. So we never buy into Bitcoin whatsoever. We don't take advantage of these kinds of rallies whatsoever. The only thing that we do is we short Bitcoin during times like this. So we only bet on falling prices. We are a perma bear and we never want to buy Bitcoin. We just want to short it. How well does the 120-day simple moving average in that case work? Because again, right, Bitcoin over all of its years was rising massively. So can we actually distill the bear markets well enough? The result is over here. So again, we've got the Bitcoin price, so that's in white. And what we've got in turquoise is when we short the index, right? This is our backtested result. And when we are in a bear market, we tend to make money. When we are in a bull market, we tend to be outside of the market most of the time. So we don't take advantage of these massive rallies whatsoever. Yet we still slightly outperform just buying and holding Bitcoin. So we're not betting on rising prices at any point in time. We're paying our 0.2% trading fees, yet we still make the same money as buying and holding Bitcoin, probably also with less volatility, as in with less down movements from top to bottom. Now, the more realistic scenario is probably to buy Bitcoin whenever we are above, but to simply be in cash whenever we are below. So we're not shorting Bitcoin. We're simply just sometimes buying and sometimes we are in cash. In this case, it looks like the exact opposite. So when we are in a bear market, we are mostly just in cash. When we are in a bull market, we make our money. This is then how the same chart looks logarithmically, right? So those are the same kind of charts, just the x-axis is different. So here every vertical line is a 10x from one another. And again, why does this outperform just buying and holding? It's because we avoid the massive crashes in a bear market. Now, I personally am more closer to this kind of performance, as in I do not short Bitcoin. I'm not a fan of shorting Bitcoin because I'm more or less a Bitcoin maxi. I believe that Bitcoin is the hardest of the monies and it's probably going to outperform fiat and stocks, etc. So I do not want to necessarily short it, even though the backtest says that it might be a good time to short. I tend to rather be in cash, and when I do short during bearish times, I tend to short the weaker altcoins. So I believe that in bearish times, the altcoins are going to crash even more, especially the altcoins that have very high token inflation. So when I'm bullish on the market, I'm long Bitcoin. I even go a bit with leverage into Bitcoin with 1.3x leverage. And when we are bearish, when I don't like what I'm seeing, then I short the altcoins. I don't short Bitcoin. But we can't necessarily backtest this very well, right? Because the kinds of altcoins to short, they change over time. And it's always dependent on the situation. What's currently inflating the most, what's currently not very hyped. But yeah, this signal does have a ton of validity, especially if you compare some shorting with it as well. And that might not be on the Bitcoin chart, it might be on the altcoins. And so have a look at this. First, we look just at the linear scale, right? We didn't really know what happened in the early days based on this scale. But when we look at the logarithmic scale, we can really see how smooth that outperformance is. The volatility is much, much lower compared to buying and holding, and the outperformance is massive. Again, each of those horizontal lines is a 10x from one another. So this turquoise line, right, this 120-day simple moving average is no joke. I do strongly believe that it is a proper signal to use, and currently that line is at 64,374 roughly, right? It is currently coming down. We are below the moving average and the moving average is going down. So the way I interpret this current rally is really how it already appears in the chart pattern, right? Where we see those lower lows and those lower highs after one another. It really seems like a temporary relief rally. It looks like short-term speculators might potentially bet on getting above 67,000. But now imagine people are going to take profit a bit earlier, right? Because they don't want to get dumped on, and actually most people are rather bearish. Imagine if that's now the case, then we might not see another failed signal compared to what we have seen 2 or 3 weeks ago. Maybe we are really already turning around before crossing the 120-day SMA. If we do, that would be very, very bearish. And so personally, with all of that data, what I am doing is I'm not trying to time the bottoms. I'm not trying to buy low and sell high. When I think that the overarching trend is rather bearish, what I want to do is I want to find entry opportunities for shorts. So for assets that we are long-term bullish on, we can buy the dip, right? We are buying the dip as we ride up. for assets or for times when we are rather bearish, we should be shorting the tops. So we do the exact opposite. We're not buying dips, we are shorting tops. And so we might be getting closer to such a top again. And so I'm looking again for short opportunities in altcoins. I'm not shorting Bitcoin, I'm shorting altcoins, and I especially like shorting altcoins that have high token inflation, where there's more and more supply hitting the market and when then demand cannot possibly catch up with that supply increase. So for example, for a long time I have been shorting this asset. I've been betting on falling prices of this asset. It's still one of my largest shorts. This is how I prefer to make money, right? When you're betting on a falling price like this with very little volatility that already went down by more than 60% since the beginning of this year, then you're just printing alpha, right? Then you don't have to time the market too much. Again, I prefer, of course, to have those kinds of positions open in a bear market, like right now, what I believe is a developing bear market. I prefer to have positions like this open during times like this, not necessarily when we are massively expanding and when most cryptocurrencies still go up, not necessarily this one though. So the reason why I'm not saying what that specific altcoin is because I want to have some kind of value also for the people that support this channel financially. There is the premium membership where I share all my positions, all my shorts, where I also share how I in general see the market. So feel free to check it out. It's down below. It's thebitcoinstrader.com. Looking very much forward to seeing you on premium. There's also chats where we can one-on-one communicate with one another. If you got value out of this video, feel free to, of course, give this a like as well. It helps the channel grow. A subscription would be very much appreciated as well. I publish videos regularly on this channel. Cheers.